Matt, where are you on what the market's getting right here, specifically going into year end?
We still like quality as a factor, so high return on equity, good margins, low debt to equity as a way of filtering through those stocks. Some of those stocks definitely pop up for us in those themes, but we do look at over the weekend there were so many bears that were taken out and killed. So much sentiment shift, and we do not want bear extinction. We want to keep some bears out there for cautious view on the market, and that is starting to slip. Sentiment is not the asset it was just a couple weeks ago for this market.
Yeah, Mike, I'm sorry, Jeffrey, different names impromptu. Jeffrey, over the weekend, a bunch of macro desks are throwing in small towels. A lot of them are centered around Fed purchases of securities. How much does that matter?
I don't know that it matters all that much right now. I think we've actually seen maybe a start of a shift to fiscal policy. We got, I think it was last week, maybe it was the week before, we got the 2020 budgets from many of the Eurozone members. They all included a little fiscal expansion. Not a lot, about a third of a point of GDP, but that's enough for a country like Germany to keep them out of recession. Remember how close they are with third quarter GDP just at 1/10 of a percentage point. So I think that shift to fiscal is important and something to keep a close eye on as we get a lot of data this week on manufacturing and the consumer.
Matt, let's talk a little bit about international, because we have seen a lot of enthusiasm for the growth that's happening around the world. And yet you've got the WTO saying that the trade flows are weak. We got some news from China that doesn't indicate that things are as good as they seemed. Where do you stand on international?
We still prefer the U.S. over international. And I never thought that I would see the day where missing a technical recession by 10 basis points in Germany would mean that the DAX would be at all-time highs. The disconnect between the fundamentals and the markets to us is getting a bit extreme. You're seeing multiple expansion there. We want to see earnings revisions recover. We want to see the PMIs continue their consecutive ascent higher. The PMIs this week are huge. We get the preliminary data. Those are great inputs, and we're going to be watching that closely.
And Jeff, when you're looking at international, you talk in your note about the role of fiscal stimulus here.
Yeah, this is important. Fiscal stimulus has turned, and what we're starting to see is a little bit better momentum on the profit side in Europe. One thing that's interesting is that yield curve inversions in the past have signaled a shift between U.S. and international geographic relative performance, if you will. And the recent yield curve inversion has also seemed to have brought this about, meaning that international markets have been outperforming in recent months, coming off of these very low valuations that they've sustained, that they've seen given the challenges they face. So I think we might be seeing a longer-term shift here in favor of international and value equities, something we haven't seen in 10 years.
Mike, what do you think about this idea that you want the bears around?
You definitely do. I think the question is whether we're now just in that process of people starting to feel better and optimism building before we get to an extreme or not. I think interesting. The idea that we're at about a 2% economy and the world is going to go back to maybe growing near trend, that comes as a relief when the markets are down 6% from a high like they were in August and people are worried about a recession. If we get the markets and sentiment to a point where everyone's looking for bigger things and better things and the S&P is up another 5% or so, then 2% in the U.S. and trend growth outside is going to seem disappointing. So nothing much has to change with the world. It has to change with prices and the move.